And Bitcoin has now 50% of the market cap of the whole crypto space. I mean, in his blog afterward, he mentioned Liechtenstein could become the capital of crypto of the world. Once we have this regulation in place, the government is planning. Just move on the other side. It's yeah, this shows that regulation is really very important. That's also on what law enforcement and governments are very much interested. The DEA, the Drug Enforcement Agency of the United States, found out lately and reported that other than speculations, only about 10% of transactions on Bitcoin are suspicious transactions. So the rumors that Bitcoin is used for illegal purposes is partly untrue. On the other hand, it's still mainly used for speculation. But I think we will this evening prove that this is not gonna stay like that. Yeah, crypto funds are really waiting to be approved in the United States, particularly. In Liechtenstein, we already have a few, but mainly alternative investment funds, which cannot be sold to ordinary investors most of the time. But big banks are working on that. And in the United States, I bet that we might have one by at least this ETF thing, which is being speculated on, will become hopefully or probably true. The Chicago Board of Exchange is planning one, and they will be decided on in November. Until then, 5 more ETFs will go through the SEC, and probably they will be declined. The first one might, in my opinion, be the CBOE, because CBOE is the second biggest stock exchange in the world, and works together with traditional banks like Goldman Sachs. Whether you like that or not, it is a fact that the traditional financial institutions are entering the market now. In Asia, it's different. There, it's pretty normal to have funds now, and I think we will have a lot of demand. But we are not here to speak about speculations. I think we are here to look at real use cases and speak about the future of Bitcoin in particular today. I just have to check whether I forgot something. So let's see what Bitcoin is going to be able to do in the future. We have 2 excellent speakers on this topic. It's once more Philipp Büchel, who is Mr. Bitcoin in Liechtenstein, I think. He works on Bitcoin for the longest, I believe, in Liechtenstein, at least of the people I know. And he has thankfully convinced Giacomo Zucco, one of the rock stars of the crypto scene. At least I've been told that. And Giacomo, he's, I don't know whether I'm wrong, he's Italian, are you? Yeah, but he works mainly in Chiasso, right? Yeah, and he will, I mean, he will introduce himself. That's much more practical for me. But he's very much in, let's say, the newer form or the more serious technology of the future. But he will tell us about that later on. Okay, we have a new sponsor. That's Gassner Personalberatung. No one is here of them, but they are really looking to offer jobs for this space, and if you are interested in finding a job, go there and ask them. The other sponsors of tonight, as usual, Eternity, Blockchainbuero, which is the company of Philipp Büchel, Core Ledger with Richard Spinden, Ganton Group is where I'm working, and Nägeli Rechtsanwälte, also as usual, Thomas Nägeli. He's not here yet, is he? No. One of the ones who got lost in the traffic jam or somewhere else. Yeah, the live stream we have is powered by Crypto Media Agency. The guys are over there. Bernhard Elkuch thankfully provides that service for us. Yeah, in the end, we hope we have a panel with Giacomo and Philipp and maybe one more person. And in the end, you will receive the usual apéro, hopefully rich. I've not seen anything yet, but hopefully it's going to be nice. I hope you are going to stay. And now I give the word to Philipp, and the magician will show what is under this black thing. Okay?
Thanks a lot. So thanks a lot for the stage, Klaus. Very nice. We might want to switch to the other HDMI cable, I think. Just in the meantime, one short and very personal notice on ETFs. I think I see that we are all craving for a big price action. We would all like that, of course. And ETFs will bring lots of price action. But think about ETFs as someone being responsible for your Bitcoins. And that's not how it is thought to be at all. So there will be a single or some few numbers of entities that are then in power of lots or of a big fraction of all of the Bitcoins. And that means you can't decide if there's a fork coming on or something like that. You can't decide which side you want to join. So those entities will decide for you. And as we are all here, I think we all can agree that we do not want to take other people that we do not want to take financial decisions of other people, but that we want to take them in our own hands. And that's kind of in danger when lots of ETFs are coming into the field, in my opinion. It's a very personal opinion, but it's just something to think about, and there are lots of opinions on that. So let's move over to the Lightning Network. The Lightning Network is a second layer solution for Okay. So the Lightning Network is a scaling solution to the Bitcoin blockchain, and that's because it was necessary to do so. So the current capacity of the Bitcoin blockchain, or of that first layer, is about 1 megabyte per 10 minutes, which comes down to around 7 transactions per second. Just as a comparison, the Visa network does today around 4,000 transactions per second and has a capacity of around 65,000. So we're with 7 far away from that. And the conclusion of that is that the first layer of Bitcoin is not a very powerful payment network. And the solution for that is, let's put a second layer on it, and that would look like that, because the Bitcoin can serve as a base protocol layer to transfer values. That's all it is. Like we have lots of times you can hear the comparison to the TCP/IP layer, which is the base layer of the internet, and that's just for that just defines how to transport information. And as an analogy, we have here the Bitcoin base protocol that defines how to transport values. And on top of that, we'll set up the Lightning Network as a payment layer, or as a micro transaction payment layer. So it's a decentralized and it's a trustless solution again. We like that, we don't want to have intermediaries or third parties that are in the middle of our transactions. So it's again trustless, it's again decentralized. It has the capacity for a very high volume. Unfortunately, I can't tell numbers, but it might outnumber the Visa network easily. It has very low fees. We'll see that later probably, or I will tell you. No trusted custodian. We have a two-party consensus again. So when two people want to transact values, they have to come to a consensus. It's open source software. It's defined by the BOLD standard. So some entities that started to make implementations designed the set of standards for the Lightning Network. That's called the Basics of Lightning Technology. That's a BOLD. And there are several implementations so far. The most popular ones are LND, we'll have a look at that today. C Lightning by Blockstream and Eclair by async and so on. There are more like that. And also important to know, the Lightning protocol isn't bound to the Bitcoin blockchain. It can basically be applied to every blockchain. They just have to have a set or have to support a set of smart contracts, which you see there. So they have to have multi-signature, they have to have HTSE and so on. They have to have checksig to do that. So that's possible. You can set up the Lightning Network on every blockchain that supports those smart contracts or those scripts. Now, how does it look? I made a little graph here where we'll show how a Lightning transaction works. First, on the bottom side, you see the first layer. That's the Bitcoin blockchain. It's one block connected to another block, so a chain of blocks. And just keep in mind, everything else isn't a blockchain, although it's called like that often. So that's the only blockchain that exists when it's a chain of blocks. We start with an anchor transaction, an anchored transaction. So the two parties that want to transact money have to commit some funds to a payment channel, to the second layer. So they are doing the first transaction happens on the Bitcoin blockchain, and they commit some funds to that payment channel on top of that. And then after that, when it's up there, they can do their whatever they want. So they will change the state of that channels and then change their respective balance. So let's have a look at that. If I think Alice is going to pay Bob 0.2 Bitcoins first or something like that. Yeah. So the balance of Alice goes down on 0.8 Bitcoin and the balance of Bob goes up to 1.2 Bitcoin. So they made now change of state of that channel. And you see, this doesn't have to be settled to the main blockchain yet, although it is a valid Bitcoin transaction. So it's kind of a real Bitcoin transaction, but it hasn't been settled to the blockchain yet. So we're going to make another change. We're now down at 0.5 with Alice and 1.5 with Bob. So they made another state change of that. And you see the channel capacity of this channel is 2 Bitcoins. So that's the maximum of funds that can flow or that can be used to transact back and forth to that. Let's say they are rid of transacting money now, and they want to close that channel now, because during that transaction, both of them have to be online. And you know, from the Bitcoin blockchain, you don't have to be online to make confirm a transaction. You just have to broadcast it, and after that you can go offline again. With the Lightning Network, you have to be online during the whole process in order to keep the channel open. And they are rid of that now, and they say, we want to close it now, and we want to settle that balance. So all they do now is settling the new balance to the Bitcoin blockchain again. And now you can see why this takes a lot of load from the main blockchain, because all of the small transactions, they happened in the sidechain, in the second layer, and therefore the main blockchain wasn't used a lot. And you still have the same advantages. You still do not have to trust a third party, and so on. Let's look at the time. The routing, I don't know how deep we'll go into that. I guess we'll skip that bit in order to have more time for the demonstration or for the talk of Giacomo, of course. The main thing is we have to take away from this is that if I want to make a payment to a counterparty, it's not necessary to have a separate payment channel to that party, because that could be very bad, because I had to open on and on channels to other parties, and with every channel I will commit a little bit of a fund to that channel, and that means while that payment channel is open, I do not have access to that fund to do anything else but a Lightning transaction. So the nice thing is, if in this case Alice wants to pay Eric, it's not necessary to have a direct payment channel. It can be routed through the Bitcoin network. And every of these hops of that nodes in between, they earn a little bit of money for routing that transactions. They don't earn that for nothing, because they also commit funds to their channel. So that's how the routing, or that's how it works when there are several parties involved and when there is no direct channel open between the two parties that want to make payments. I think we don't want to go deeper into that routing. You can ask me afterwards how exactly the routing works. It's very beautifully made. You can the routing has, or the payments on the Lightning Network in general have a very high degree of privacy, and so has the routing. So the hops that are routing the payment, they do not know anything about the route. They don't know where it comes from, where it goes to. They just know the next hops, and that's the only information they have. And they also don't know how many hops are there in total. It looks to them like there are always, there's always the same amount of hops. Very beautifully done, very thought through, of course. Now let's go to the demonstration. In order to make a Lightning transaction, you need to have a Lightning node where you can open a payment channel to another node. And you can make such a node. You can run it on your computer, for example, or you can run it on a separate hardware, what I did. And you have a low energy consumption then, depending on what hardware you do that. So that means it's not mining or anything like that. So it's not to be confused with mining. You don't need to commit a lot of energy in that case. And you can be your own bank, because you also need a full Bitcoin node below the Lightning node. And that means you have verified all of the transaction of the whole Bitcoin blockchain, every transaction that happened. You have verified that, and you are in full control of that node. So you don't have to trust anyone, like with the lightweight clients, or with lightweight clients you have sometimes some degree of trust, but for sure most of the times some loss of privacy, and you don't have that when you run a full node. So I built one, and I am very happy to present you today the Lightning node. So that's a full node. You see that's the full Bitcoin blockchain is on that, and this is the cell of a worldwide decentralized payment system. And it's running now. Can you see that from there? It's now the moment where some of you might start to grasp the beauty of decentralized and cryptography-based technology, because you see that this very simple, almost fragile-looking hardware can be the backbone of a worldwide network that is highly secure, highly reliable, and just the cell of it, or the single cells of that network, do not have to be secured at all. So the whole infrastructure, what we have in, for example, banks, where you have the vaults, where you have the security, where we have walls and guards and weapons and all, we do not need that, because we have decentralization and we have cryptography. So that's what makes it special. And you have to check that when you look at other blockchain projects, for example, if it's really the same, because that's the root beauty of that whole technology. So I can run on a very fragile hardware, I can run, or I can participate in an ultra secure network. Let's see what happens there. I will try to make a transaction now. I'm not sure if it works. I had to move it from home, and therefore I had to close all of the payment channels I had open, and I had to make new anchor transactions. So you remember that's the initial transaction where you commit some Bitcoin to that payment channel. And those transactions probably didn't go through yet. So we'll have a look at that. It's going to be a bit nerdy now. Let's have a look if it still works. Yeah, if there happen to be electrical engineers present, please do not come closer to that. You might get shocked, and I mean that in both meanings of the word. So stay away from that. Let's have a look at that. Looks crazy on first sight, but not so severe. So you can see on the right side, you can see the log of the Bitcoin node. So that's new blocks coming in every 10 minutes. Let's have a look. No, we don't have one. So every block that is coming in, we'll see one later, is verified here, and that's what happens on the Bitcoin network. Every single node of it verifies every single transaction that has happened, because we do not trust the other nodes. We do not take things as given that come from the other nodes. That's why we verify. Do not trust, verify is one of the big mottos, you know that. On the left side, we have the log of the Lightning client. It's the LND implementation here. And on top, I'll have another shell open to give commands. So those are all remotely running on that Raspberry Pi there. All you need is a Raspberry Pi, a large enough hard disk to store the whole Bitcoin blockchain, and that's it. So it's basically just two parts. I put a display on it to have to make it look more fancy. So let's have a quick look at that. I'll see if there are more channels open. There are not. Yeah, we just have one channel open. So I will tell you what happened. We can look up the node on an Explorer. So you can see here. So that's now an external site. And I can see there's the Blockchainbuero Lightning node up and running, and it's participating in the network. But it seems or we just have connection to one other node, so we just have one payment channel open, and that could mean that we will run into routing problems. So if that other node is a very unpopular one or not well connected, then it could be that our payment doesn't route through to the receiver. But we'll see what happens. So just one quick sec, or I will answer it like that. Yeah, I see that channel is even inactive. That's a problem. So we have funds there. I opened other channels. You can see them. You can see the anchor transaction here, but they didn't go through yet, and I don't know exactly why. So that's a problem. So those channels couldn't be opened yet because the transaction has to be confirmed on the Bitcoin blockchain. We'll try anyway how it would look to make a payment. So that's another picture. That's the mainnet Lightning network at the moment. So that's a live view of the network. You can see all the nodes, all the connections between the nodes. And if we look for our node, I'm afraid there it is, but it's very sad. Can you see that? It's there, and it's really lonely. It's just out there, and no one wants to talk to it. It's really bad. We are in the process of opening channels. I can show you that quickly. So here see we have two pending channels that are waiting to be opened, and those are much better connected. So the one we have is even inactive, so we do not have any connections, so we can't make any payment, but we'll try anyway. So you see, one very general impression you might have now, this is all, and you will see this is all really early stage. So I have to work on the command line. I had to do it all by myself, setting it up, and it's really inconvenient to do now. But this will change quickly. There are quite nice Lightning wallets in the development, so there are some that you can have on your phone already. I'm sorry that I couldn't set up, or that I didn't have time to set up one like that. So I could theoretically, now connect my phone to that node, and then I could make Lightning payments from my phone. But that's not happening yet here. It is in some other cases. I'll show you now how a payment would look. So that's a website, and I have a small pseudo payment processor here, and let's say we want to pay to that site like 0.1 cent, and transacting 1 cent on the Bitcoin blockchain would be horrible, because you would pay fees from like 15 cents to $50 US. No, not anymore, but there were times like that. And here fees will be much lower, you will see that. So what happens then is we have a payment request generated, very similar to those you know from like Bitcoin payments. And then all we do is we copy that payment request, and just a second. Yeah, I see that. It wanted to work, but it didn't. So what's the error message there is unable to find a path to destination. So it couldn't do the routing because that node we tried to connect to is somehow not well connected. So it didn't work out, unfortunately. And I'm really sorry for that because I worked hard for that presentation and now it's not working. It's kind of a bummer, you know. But I can tell you, when I made a transaction this morning, I bought a pseudo beer or something like that. So there's, no, that's not true. I made another payment for 1 cent and the fees for that transaction. So the transaction went through immediately in lightning speed, of course, and the cost of that transaction was 0.7 millicents. That's 0.0001 cent that I paid for the transaction. So take that, Visa. And it was routed immediately and it was confirmed immediately and it went through. And it's a shame that I couldn't show you that tonight. But as you see, it's all early stage and yeah. Yeah, we don't. That's nice. Thanks for that. So, yeah, that's again the node. For those of you who can't see it, all of you who aren't electrical engineers are, of course, allowed to come closer after that. So you can see here, that's just a Raspberry Pi, the hard disk back there, and the display in front. And it's working, it's connected to the network. I just didn't manage to open a payment channel so far. And I think we'll go through that. We saw that. That was like my plan B if it wouldn't have worked at all. And I think we'll skip this the questions. We'll do that at the end. My name is Philipp Büchel. I run the Blockchainbuero. You can, if you have further questions, you can anyway or anytime you can send me emails or connect on Twitter. And if you have projects, if you need technical advice for your blockchain problems, or if you want to make workshops, if you want to have talks, you can call me up. Thanks again thanks a lot for listening. Now, please, Giacomo, we'll have a look now what's also possible on the Bitcoin blockchain, and I'm really looking forward to that.
Thank you very much, Philip. Thank you for inviting me here. Very glad to be in Vaduz. So I'm Giacomo Zucco. I'm not sure I'm a rock star, as the Gentile introduction said. I will try a stage dive at the end, so let's see how it goes. So please be responsive. My education is theoretical physics, but I worked for a multinational consulting company as a technology consultant for a while. Then I quit in order to do Bitcoin stuff in 2013. And I worked in many very, very small Bitcoin-related startups. And in 2015, I started my own consulting companies in Italy, Bulgaria, and Switzerland, mainly Switzerland. I'm consulting mostly banks about Bitcoin storage security and companies about timestamping, notarization. Mostly 90% of my business is telling people what they shouldn't do on a blockchain and what they cannot do on a blockchain, and what Bitcoin is not about and blockchain is not about. So I am like an unblockchain consultant. I'm explaining why you don't need a blockchain mostly. Also, I am running the BHB network non-profit operation, which is our best way to try to help the ecosystem. So we receive donations mostly from our clients, and we redirect these donations toward Bitcoin development and sometimes education and conferences as well. Today I'm going to present here, I already presented in very, very quickly in a Building on Bitcoin conference in Lisbon. I am going to go a little bit more in detail here, also assuming a little less of knowledge of the underlying systems. one discussion about the idea of putting generalized assets or tokens on a blockchain. So I'm going to talk about assets on Bitcoin. This presentation that was originally subtitled, yes, okay, financial sovereignty and crypto anarchy are cool, but what about those crypto kitties? Is about the reasons to use Bitcoin-derived systems, and specifically blockchains, or cryptocurrency-like structures, in order to transmit, store, and issue generic types of assets like equity, bonds, IOUs, fiat currencies, or whatever. Of course, when I say on top of Bitcoin, we can mean a lot of different things. I will try to clarify what I do mean with on top of Bitcoin in the context of this presentation. I will also present the effort that BHB Network no-profit foundation is leading in order to try to establish a new, or to propose at least, a new standard about how to do properly this kind of things. So the first 10 to 15 minutes of my talk will be just about what is the reason we even have to try, we even have to discuss generic assets on top of the blockchain. Does that make any sense at all? And then the second part of my talk will be about the presentation with some technical details of the RGB proposal. It will assume some knowledge about the Lightning Network, because this presentation, this protocol proposal is very, very close to the Lightning Network effort. It's leveraging much of the Lightning Network development, so I will try to show you how the two things do interact. So the people among you that thought a little bit about this problem about generic assets on Bitcoin are probably asking themselves these 4 questions. First, if you do have a centralized issuer or redeemer anyway, why even bother with decentralization of transfers? So I'm a company, I want to issue new shares for my company. Of course, it's nice to think about digital, have a digital version of my shares. But why should I have decentralized versions of my shares? If I'm a centralized company, the people have to trust the issuer anyway. When they want me to convert back rights, voting rights, dividends, or whatever, they have to trust me again. So if you are Starbucks, or if you are like an air flights company and you want to issue miles of flights, or you are a telephone company and you are issuing minutes of airtime, people have to trust you about the significance of those tokens anyway. So why should you use a very complex, very, very hard to scale, very, very hard to maintain decentralized network like Bitcoin or Bitcoin-derived technologies? Typical answer is, in my consulting job, is don't. Don't use a blockchain. Don't use Bitcoin. Just use your MySQL. If anybody of you is interested in the private blockchain business, there is a very, very cool website. It's called www.myblockchain.xyz. It's great. Basically, it's a fork of MySQL database where they call the tables blocks and they call records transactions, and now you have a private blockchain. And you should just use that because it works perfectly. So why you shouldn't just use your own centralized server, since people is trusting you anyway? What are you decentralizing here? The second question is, even if you need some degree of decentralization, why should you build it on Bitcoin or Bitcoin-derived technologies like a blockchain, and not on something more specialized and more ad hoc? Sometimes there is people that come to us claiming that they are building a new decentralized version of GitHub, that already exists. It's called Git. I mean, often you already have, since decades, decentralized protocol. You have BitTorrent if you want to transfer files. You have Git if you want to sign and chain hashes of different commits to code. You have IRC if you want a decentralized system to chat. You have a lot of decentralized. Internet itself is a decentralized network. And news groups in the 70s and the 80s were already decentralized application. You don't need a blockchain every time you need a decentralized application. Like PGP is a decentralized application for identity. You don't need a blockchain for that. The third question is, even if you convince me that you should use a blockchain or Bitcoin, specifically Bitcoin, which is the most secure, advanced, reliable, and used blockchain around these days, and probably going to be the same for a very, very long time. Why should I use that? Isn't that maybe, isn't there a risk, some risk to mess up with the incentives of Bitcoin? For example, if I use the space inside Bitcoin blocks in order to transmit my own company shares, am I consuming scarce resources that people need in order to run Bitcoin? Am I putting some kind of overhead on top of Bitcoin nodes? So, or maybe I'm messing with the game theory of Bitcoin. Like right now, game theory in Bitcoin assumes that the more value you have on the Bitcoin network, the more value you have on the fees paid to miners, and so the more profitability and hash rate you have. But if Bitcoin is starting to maybe being used as the base to transfer Apple shares, Apple market cap is basically big enough to mess up completely with the typical game theory assumption of Bitcoin. So aren't you going to break Bitcoin doing something like this? And the last question is, okay, you convinced me that there should be some reason to put assets, generic assets on Bitcoin, but people already tried that a lot, and it really never took off. I mean, a little bit right now, there are a lot of people scamming other people on Ethereum with ICOs, but mostly that's all we are seeing right now. Some Ponzi schemes, but not really like real-life assets traded on a blockchain, because it doesn't make a lot of sense. So why did Counterparty not take off? Why did Colored Coin project not take off? So in the last part of my talk, I will try to give you a very quick overview of the assumption of all these different attempts: Colored Coin, Omni, Counterparty, altcoins like Ether, ERC20, and I will try to tell you why I do think that they failed, and why a new proposal could maybe learn from the past and try to fix the problem of the previous attempts to do this. So let's start with the answer to the first question. Why should we even bother putting some kind of generic asset structure on top of Bitcoin? I prepared this presentation to be presented in Building on Bitcoin, where people is very, very conservative about Bitcoin. It's not that was not an audience that was like waiting for new use cases for Bitcoin. In that context of Bitcoin developers, you really need to have a solid reason to try to mess up with Bitcoin. And so I prepared a very conservative arguments in order to try to claim that we do need this kind of experiment. The first one is the vape pen argument. So smoking is bad for your health. You shouldn't smoke, but if you really have to smoke, at least you should use the way that minimizes the damage. So probably there is not really a reason, let's assume there is not a compelling reason to do assets on Bitcoin or on blockchains. But the fact is that people right now is using the worst possible kind of standards in order to do that. They're using ERC20 on Ethereum, which has zero scalability, zero privacy, zero fungibility, sub-zero security. That really, from an engineering point of view and from an economical point of view, it's crazy to use those kind of standards. So even if we're not really convinced that we should put assets on Bitcoin, Since people is trying to do something like that, please at least do that in a way that minimizes the damage. I'm a little bit hypocritical in making this argument because I smoke cigars. But let's assume I don't for sake of argument. The second argument is the Jenga argument. Do you know the Jenga tower? So when you try to, when you are playing Jenga and you have to move a block which is at the very bottom of the tower, you cannot move it because the weight of the tower is keeping it very, very stable, and if you move it, you basically crush everything. So the thing about layering technology is that it makes the underlying protocol very, very difficult to kill, to censor, to change, to mess with in general. If we do want Bitcoin, and I do want Bitcoin to be very difficult to shut down, very difficult to censor, very difficult to change, very difficult to corrupt, to manipulate, to co-opt, to hijack, then I want Bitcoin to be at the base of a tower of second and third and fourth layers. Even if I'm not really convinced about the utility of the upper layer, still the upper layer somehow creates strength for the lower layer. I have like an example that I think is kind of interesting, a mental experiment. So you know that at the beginning of the 90s, there was the protocol war about the intercommunication protocol. So there was the internet, the protocol of the nerds. It was existing since already more than 20 years, like TCP/IP version 4 is 1983, so it's my age, the final version, with very, very few modifications. So since 1983, there was this very old, very stable protocol, TCP/IP version 4, and then there were like the fancy new protocol, like the protocol coming from the regulators, so the ISO-OSI protocol, there was like the protocol coming from Xerox, from IBM. Everybody had his own alternative to the internet. The internet was just the old, boring, nerdy protocol. Of course, the internet won that war. And then, fast forward, at the end of the 90s, you had the dot-com bubble. Now, the dot-com bubble was mostly a giant Ponzi scheme, pretty similar to the ICO ecosystem you see right now. But try to ask yourself this question. Would be internet better off if all the dot-com scams like pet.com or all that scammy stuff was built on top of an internet alternative instead of the internet? I think not. I think that the fact that the market tried to build things with the dot-com bubble on top of the internet, the real internet, and not the fake internet like ISO-OSI or Xerox or IBM alternatives, actually did something to stress test, it did contribute to make the internet stronger, even if it was just a market bubble, even if it was not economically sustainable, and even if it just crashed down. If you follow me, probably you are imagining some very subtle metaphor I'm attempting here, yeah, Bitcoin is the real protocol. All the other protocols, private blockchain, scam coins, they are just copycats, they are just clones, they are going to disappear. But people is scamming people with the ICO bubble, which is very similar to the dot-com bubble, on top of other protocols and not on top of Bitcoin. That annoys me. I mean, if you are going to scam other people, let's do that on Bitcoin, please, because we need to stress test it. We need to see how it scales, how it can accommodate multiple layers. So I want scammers to come to Bitcoin. Bitcoin ecosystem is too much unwelcoming to scammers right now. The third argument is the permissionless stress test argument, which is, the name is not as cool as the other name, so I probably have to change it. But the bottom line is, if something can be done on top of Bitcoin without changing Bitcoin, and that's the case for RGB, somebody will try to do that. If you can put your data on Bitcoin, people will try. If you can do stuff on top of Bitcoin, people will try. So there is no way to stop them. That's the whole point of Bitcoin. So we should experiment with this kind of layering, because if people want to do that, they will do it. So we have to stress test the platform to understand where the risks are, where the problems are. And that's one of the reasons we are doing RGB at all. The last argument is the architectural experiment argument. This is also a very ugly name, and it goes like this, basically. There are some architectural alternatives to the Bitcoin blockchain, very different alternatives that are interesting. You may have heard about DAGs and tangles instead of linear blockchain. Of course, maybe you have heard about that because of the IOTA scam, but even legit people is experimenting with that since 2013, at least. It doesn't work. You cannot make it converge, so it diverges, but it's an interesting experiment. Also, there is like other alternatives like, I don't know, proof of stake. It probably doesn't work. Wei Dai already proposed the proof of stake with Bin Money in 1998. Then he realized that it was not going to work, so people moved to proof of work, and now some marketing initiatives are taking back proof of stake as something new, but it's not, already filed in 1998. But it's interesting to maybe experiment with that. There is another technological choice, which is called client-side validation. I will go into some details about this. It was an idea by Peter Todd, the Bitcoin developer Peter Todd. I give you some spoiler. Basically, in Bitcoin right now, every time you have to create a transaction, you have to give the data of this transaction to every single node of the network. So every single node will have to register, independently validate, and store forever, bar pruning, but still store forever your single transaction. So I buy a coffee, and every node of the network will store forever my coffee. That is terrible from an engineering point of view, as you can imagine. Of course, Lightning Network solves that in a way. But Peter Todd had this other idea, and he said, since the only thing that the blockchain actually does is to prevent double spending, proving a publication, so the Bitcoin blockchain is a giant proof of publication system. You are doing all this complex stuff with proof of work and rewards and fees just in order to prove that when you publish some transaction, you are not also publishing a transaction that contradicts this transaction. So it's a way to create a single consistent history of transaction. So why do you need to put all the data of the transaction inside this proof of publication system? Maybe Peter Todd's reasoning goes like, maybe you can just pass the content of your transaction peer-to-peer to the other person, so not to everybody, but to the specific target of your transaction. So Alice has to pay Bob. Alice sends information of the payment only, and proof and signature and everything only to Bob. Bob is the only one that has to validate, run the signature verification. And then Alice put a proof of publication of that on the Bitcoin blockchain, only the proof, which is way more scalable and way more private. This is an architecture that is very interesting, but you cannot change Bitcoin to try that. It's an experiment, maybe it does work, maybe it doesn't, so we cannot use Bitcoin. But we don't like the idea of using altcoins, because the problem with altcoins is that they are trying to replicate the same function of Bitcoin, digital scarce gold, and that cannot work for different economical reasons. In my opinion, which is correct. You don't want to recreate Bitcoin. You don't want to recreate Bitcoin from scratch. That's crazy, useless, and even harmful to the overall experiment. So why can't we try to apply this architecture that we really want to experiment with, not on a Bitcoin clone, but on stuff which is not Bitcoin at all, like generic issued assets? So that was the trigger that got us trying this stuff. So after these arguments, you will think that I think that there is no legit use for Bitcoin-based assets, and I'm just making up excuses to experiment with a cool technology, which is partially true, but I will make some effort to try to give you some use cases that can make sense when we're talking about Bitcoin-based asset. So the first generalized use case is asset independence. So there are some cases in which the asset is issued by an issuer, but then the destiny of the issuer is not important anymore for the destiny of the asset, because the asset is completely independent from the issuer, or because there is no centralized issuer at all. The typical science fiction example of that are smart rights. For example, the smart equities of a DAO, a decentralized autonomous organization. The term DAO is a legit term. It was invented in the 90s, and it's an interesting term. Of course, the DAO scam projected a very, very shady light on the term. But the term is legit. Are we ready for a DAO, so a completely decentralized, completely autonomous organization with decentralized shares, decentralized voting? Probably not. It's probably technically unfeasible right now. But the idea is interesting. There are some legit experiments. For example, you may have heard about the BISC decentralized exchange, BISQ. It was formerly called BitSquare. Now it's BISQ. They're trying. So it's an open source decentralized exchange, peer-to-peer, without any bank involved, without any KYC, any AML. People is using it that permissionlessly and trustlessly, but there is a central developer taking decision and acting as an arbitrator. And this developer is a very good guy, Manfred. He doesn't like this position because it's a very dangerous position. So he wants to decentralize decision-making, decentralize like the escrow function, and he's trying to build a DAO, and this DAO needs smart rights. This is a very forward-looking scenario. Don't assume that we will see functioning DAO right now. But when we will, and eventually I think we will need tokens to represent voting rights, to represent dividend rights, royalty rights, and whatever. Then there is asset transparency. Asset transparency is a situation like this. I am a centralized owner. I will issue my shares. I really don't need the shares to be decentralized, but the only reason I'm using a blockchain is to prove that I am not making up things about scarcity. So, for example, I am Apple. I am issuing my shares on the blockchain. I don't really need the blockchain, actually. I can do that on a database. But I use the blockchain to make you retail investor or you regulator sure that I technically cannot manipulate the supply, the total supply. I cannot arbitrarily change an amount. I cannot move the share from this person to this person. So you're still trusting me for the value of the share. The dividend have a value because you're trusting me. The voting rights have a value because I'm enforcing that right. But you can check me. You can check that I'm not changing stuff. So I'm using the blockchain for transparency reason, basically to prove scarcity. There is like a middle ground here, which is CryptoKitties or rare peeps, which came earlier. So digital collectible. Digital collectibles are interesting cases because if you think about collectibles, you can have the issuer, the company, the centralized company issuing the collectible. Then the centralized company can disappear, like a digital artist can die, and so the collectible, the artwork would be even more valuable because he died, poor guy. And you can have Beanie Babies. The company issuing Beanie Babies disappears, but Beanie Babies are still collected. I mean, there is people collecting coins issued by the Roman Empire, which is no longer here. Even when the issuer disappears, the collectible still has some value. The problem with digital collectibles is that if the owner issues a digital collectible on his computer, on his server, and then it closes down, it disappears, the digital collectible itself has vanished forever. With a blockchain-based digital collectible, that's not the case. So I think this is a very legit, CryptoKitties on a blockchain can make some sense. Then there are two use cases. I will go quicker because I'm a little bit slow. One is asset blindness. This is a little bit tricky. So the idea behind this is, let's assume, for example, I am a company that are asking for US dollars, and in exchange I give you tokens representing US dollars, and we can just trade back and forth. So I am a regulated company. So I will only accept clients with full KYC, AML regulation. If you give me dollars, I will have first to KYC you. And if you ask me to have the dollars back, showing me the token, I will have to KYC you. But there is a whole secondary market happening behind my back, which is not regulated at all and is happening. So any reference to any existent US dollar pegged cryptocurrency is completely random. But this is a very smart move, because using a blockchain based assets, a central company could somehow circumvent regulation, limiting the regulation to the primary market, to the primary market, and leaving a free secondary market free to provide liquidity, which is very interesting for asset issued. So this is another interesting thing. So the last argument is asset standardness. The thing is, think about this other comparison with the internet. I use a lot of comparison with the internet because Bitcoin is really something very close to what the internet has been for information, for value. So you are in the beginning of the 90s and you want to create a permissioned, closed, controlled business network in your company. You don't want to use the internet. You want to use a mainframe. You don't want to create a private internet, which doesn't make any sense. You used your mainframe because the mainframe is the best thing to control, to centralize, to maintain the permissional level. But you're doing the same thing in 2018. Now, still, you do want to control, to grant permission levels, but the internet already exists. It's everywhere. You have a free infrastructure already built by other people to do other stuff. So you do a private portal for your company on the internet. So you take the open permissionless standard and you put a permissioned closed layer on top of that. Why? I mean, people right now is maybe messaging on WhatsApp like, this speech is boring, and this sentence is going to a router here to the GPS system to China maybe, and then back to the Wi-Fi. That doesn't make any sense. That's an abuse of decentralization. But since decentralization is already there, the easiest way to is to piggyback on that and to leverage that. So out of this metaphor, if you do have Bitcoin already used everywhere, then you should use a Bitcoin-based asset standard, just because you will leverage existing software, code-based, libraries, tool, best practices, user habits. So this is the reason that many people right now is using ERC20 standard. Not because they need any decentralization. They don't. Actually, when you use an Ethereum smart contract, you are paying 80 million times more than using Amazon AWS. Why are you doing that? For censorship resistant? Not really, because Ethereum is not censorship resistant. You are doing that because of standardness, because other people is doing that. If I have a company, I want to issue some fidelity points, and I need the person to download my app connected with my server, that's a social friction. But if that person already has an Ethereum wallet, and there are like 3 or 4 of them, that's easier for me to piggyback that. So there is some reason to do blockchain stuff, even when you are not leveraging directly the characteristic of a blockchain, just because it can become an open standard. Of course, this reason will be very compelling in many years. So in 2018, you do use the internet for everything. In 1992, you don't. That's the same thing for Bitcoin. Probably in 2018, you shouldn't use Bitcoin for everything. Maybe in 2030, if things go as they should, that would make some sense. Of course, you can have the regulated, wink wink, rights of the other use cases justified for your plausible deniability is that you're using blockchain just because of standardness or because of transparency. But actually, you are also allowing a big secondary market on top of that. So now I go finally to present RGB, and I will try to present the previous efforts in this direction in a very quick and systematic ways, answering to the last 2 questions together. So hasn't this already been tried and kind of failed, and isn't this going to damage Bitcoin somehow if we do that? So let's take a look on different experiments. The first, so you want to issue your company shares on Bitcoin. The first idea that you have is you create an alt chain, an asset-specific alt chain. So you create a new blockchain only for the shares of your business. This, I mean, I wrote some things in this slide, but I'm not even going to analyze this. This is a very bad idea. You should never, never, never create your own blockchain. Please do not create your own blockchain. It's a very bad idea. I don't have enough to discuss that. Then there is the second idea, which one specific asset-enabled blockchain. So Bitcoin is not natively granting me the possibility to issue native assets. So maybe I can use another blockchain that does. Like this is a Ethereum or a Ravencoin or a NXT case. Still, you have a lot of issues with this. Like the first issue is that you need to bootstrap everything from scratch. In the first example, you need to bootstrap everything from scratch for every single asset, which is crazy. Now you have to bootstrap everything from scratch just once. But still, it's very, very difficult to do that. Like you have to reach a minimum threshold for hash rate, otherwise your blockchain is not secure. Which is very difficult to reach and to maintain. You have to reach and maintain a minimum review maintenance threshold. That means that right now there are literally hundreds of the best engineer out there, the best cryptographer, the best distributed system expert, the best game theory expert working on Bitcoin. There will not be the same amount of peer review and maintenance on your pet project. So you don't want to bootstrap that kind of critical mass from scratch because it's not going to work. You create your own internet. Fine, who is going to maintain that? Nobody. People is going to maintain and check and review the real internet, not yours. Then there is like a real decentralization, very difficult to achieve. Bitcoin is decentralized because of very specific historical motivation. It was created by a pseudo-anonymous guy or guys or girls. They disappeared, which is very, very difficult to replicate. They were very good at OPSEC, so really nobody can anonymize them, which is very, very, very difficult to do, really difficult. They didn't try to get rich from it, not directly at least. They didn't ICO, they didn't premi. They were very, very fair in the distribution. Nobody was checking on them. So you can be kind of sure that there was no intelligent agency trying to compromise Bitcoin back in 2009 because nobody was looking at that. It was like just yet another nerd experiment like B-Money or Big Gold or whatever. Right now, if you try to replicate something like this, you will be compromised since day zero if you have any chance to success, but by definition. Or you will have just a leader, and when the leader of your blockchain gets a cold, your asset will fall down and the opposite, which doesn't make any sense. Also, very high incentives for scammers to join, because if you are launching a new blockchain now, you will just attract scammers like a honeypot, because there is a lot of money and Lambos to be made out of that. Also, your scam coin is in direct competition with a Bitcoin asset, which is a very, very bad position to be in. It will lose to the real digital gold. Finally, very, very reduced privacy, because the privacy on a blockchain is already pretty bad. You know that, right? On the blockchain, you can follow everything, you can trace everything forever. And so that's why Lightning Network is also useful, because you don't use the blockchain too much. You use the blockchain only when strictly necessary, so you get more privacy and more fungibility. Fungibility and privacy on an alt chain are even worse because the anonymity set is smaller. So it's even easier to de-anonymize you. Like de-anonymize your ERC20 right now is really super, super easy. There is no chance to stay anonymous with something like ERC20 because your anonymity set is like this. Ethereum is account-based, so you can be tracked down immediately. No privacy at all and no fungibility at all. You should mind that fungibility is a essential characteristic of money, because if money is not fungible or fungible, then you have high verification cost, so it cannot work as money. So we go on. Instead of an asset-enabled alt chain, we create an asset-enabled side chain. So the idea of side chain is, I create a new system that can issue assets, but instead of creating a new Bitcoin, which cannot work, I will reuse Bitcoin assets, and instead of creating a new hash rate from scratch, I will reuse Bitcoin hash rate. This is the side chain idea. Right now is working with a catch like Liquid and Rostock are trying to do this. Rostock is a project which is a little bit meh, but Liquid is a very sound project. But still, there are a lot of different security assumptions. They are way more centralized and way more permissioned. They are easier to censor. Like censoring Rostock or censoring Liquid is pretty simple as compared to Bitcoin. So there is not much censorship resistance there, even if Liquid is a very good experiment. So, and here we go closer to the experiment that you may have heard about. You can try with asset-enabled meta chain. What I mean with meta chain is use Bitcoin, which is censorship resistant, decentralized, the best of all. Use Bitcoin, and on top of Bitcoin transactions, you put information that can be decoded as meta rules for a top layer protocol. This is the case for counterparty protocol, which is used for rare peeps collectibles. This is the case for Omni protocol, which is used for Tether, for example. So this is a neat idea. But the problem with this idea is that still you still have high incentives for scammers, because these protocols, they can use Bitcoin underlying, but they do need to issue another generalized asset, like Counterparty has the Counterparty coin, Omni has the Omni coin. So you still have incentives for scammers to create a new pump and dump. Also, you have a conflict over scarce resources for fees, for metadata. So just to make an example out of this, Counterparty was a pretty good project, but then Counterparty needed a lot of space to encode this meta transaction into the Bitcoin blockchain. And the Bitcoin nodes, they don't want extra space, they want to minimize the space. So like they were fighting in order to have bare multisig to encode data, and the Bitcoin developers were saying like, no way, you are not going to use our full nodes, you're not going to put extra effort on our full nodes in order to keep encoded your information, because you are not Bitcoin. Also, these collectibles, rare peeps, the frog pictures. Sure, you can trade a rare peep on Counterparty, but the picture, the real collectible, is not on Counterparty, because there is no space to put it, because blockchains are terrible to store data. Blockchains are not a way to store your data. They are like the worst digital structure ever to store your data. So there is a problem there. If you go to censor the peep directory website, you destroy all the rare peeps collectibles. The same for CryptoKitties. You think you do have a CryptoKitty in your Ethereum wallet. You don't. You have just a token which is connected with a centralized server. And if I take down the centralized server, no information of the CryptoKitties is available anymore on the Ethereum, because there is no space on blockchain to do your stuff. Also, there is there is a great problem about SPV. So when you have a Bitcoin wallet on your cell phone, you don't have a real full node, as Philipp said. You are not really validating transaction, because there is not enough space and processing power to do, and bandwidth to do that on your cell phone. So what you have is that you check the last transaction, and then you just trust the mining majority. So a real Bitcoin node do not trust miners for validity. It does trust miners only for chronology of valid transaction. So I can check validity on my own, and I trust miners only about relative chronology, while your cell phone cannot do that. He has to connect with real nodes, and he has to perform this SPV technique. The problem with SPV technique is that it assumes that the miners are enforcing the Bitcoin rules. But the miners are not enforcing the counterparty rules or the Omni rules or your meta chain rules. So you cannot trust the miners in validating your asset meta protocol transaction because it's not their job. Their job is not even to validate Bitcoin network, strictly speaking. So it's just to confirm, not to validate. So this is a big problem. You cannot have a real counterparty Omni wallet in your phone. It's not a real wallet. It's not a real node. It's not even a real wallet. You are asking to a centralized server. Another problem with this is with the hardware wallet. You have a Ledger Nano S. You can check Bitcoin with SPV, with their server. You cannot use SPV to check for your counterparty tokens. So you are trusting the central server completely. They can lie to you in every possible way. There's nothing decentralized there. So it doesn't work very well. Also, there is still minimum review maintenance. Just to give you an example, counterparty is still trying to implement segregated witness since a lot of time because there are no developers to do that. Developers are working on Bitcoin, not on counterparty. So there is a friction to try to keep it maintained. Also, there is a reduced privacy because, as I explained, the anonymity set of a counterparty token is very, very small. Bitcoin blockchain is super public and eternal, and your token is super easy to trace. And then there is easily broken compatibility, etc. So let's go one step further, and finally we arrive to the design that I'm kind of presenting tonight. The last step is colored coin protocols. The colored coin idea is basically an idea in which I don't create a meta layer. I just use normal Bitcoin transaction, and I just give to this Bitcoin transaction, to this Bitcoin fraction, some particular meaning. Like I take one Swiss franc banknote or coin, and I use some method to write on the coin something which I care about, and I transmit the coin. So you leverage the Bitcoin network as is, not a meta protocol, the real Bitcoin transaction network. So it's a kind of SPV, etc. And you just make some coins unfungible, representing your asset. This doesn't work for many reasons. You have problems with amounts. For example, there are just 21 million times 10 elevated to the 8 power satoshis. If you need to issue 22 million coins, you have a problem. Also, there is the dust limit. You cannot transact a transaction. You cannot do a transaction with 0.0000001 Bitcoin. The network will just reject that because it's a waste of bandwidth. So you have a problem. Then you cannot have very asset-specific, complex smart contracts like very complex behaviors. Privacy is still terrible because it's still basically colored coin idea works only because the privacy of Bitcoin sucks. If the privacy of Bitcoin gets better, colored coin idea stops working because it's based on unfungibility. Also, there is no space at all for metadata. You cannot put the metadata of your asset, like the picture of your rare peep, on top of a colored coin. You cannot do that. So there is no space. So you need a centralized website. So you are back when you started. So SPV is still very difficult to do, is still challenging. Finally, so there are some implementation of this idea like Colu, Chromaway, but none of that even ever got any traction, actually. Well, the last option actually is to change Bitcoin in order to make space for privately issued assets. This is not going to happen. Bitcoin will not change to accommodate this use case. Forget about it. This is just not how Bitcoin works. Bitcoin doesn't change in this way. So there is an alternative design, which is the one we are using for RGB, which is called client-side protocol. So the idea of client-side protocol is that, as you remember from the beginning, instead of putting my transfer information on the blockchain, I give you directly the transfer information from me to you. You validate it. The blockchain do not validate it. and then the blockchain only stores a proof of publication for that transaction, which is way better because now you have a space for metadata, you have good privacy, because people looking at the blockchain cannot see that you are transferring any asset. So your anonymity set is even greater than Bitcoin's anonymity set. You have good scalability because you can do SPV, because you already have all the previous transactions that you can independently verify. So this model seems to solve many of the problems that the previous model couldn't solve. Still, this model has two very, very difficult challenges to solve yet. One is, with Bitcoin, I don't have to create a transmission layer. I make my transaction, I send my transaction around, and somehow it will arrive to you because it's a gossip protocol. I send everything to everybody. So you will receive it. When you give me your address, you don't give me your IP address. You just give me your cryptographic address, the hash of your public key. That's everything I need, because somehow my transaction will arrive to you because it's going to every node. With a client-side validation, when you give me your address, you need to give me your physical machine, IP or Tor or whatever address, in order to reach you on a relay network, which is more difficult to do. One of the big problems with this is that you have to be online when I give you the asset, because if you are offline, I cannot reach you, I cannot give you the proof, which is a very, very bad user experience. The second problem is difficult of backups. Right now, with Bitcoin, I store my private key in different locations, and if I lose everything but the private key, from the private key, the private seed, I can still generate all my private keys, all my addresses, and I can get back all my Bitcoins. But with this kind of model, if I store my seed and I lose the proofs, which are client-side, then I don't have my CryptoKitties anymore because I lost the proofs. So I have to manage a difficult backup, which was not a problem in Bitcoin. Fortunately, there is a thing here. Why this time is different? Mainly for the Lightning Network. The Lightning Network is great because first is providing better scalability to Bitcoin, and an RGB client-side validation model can leverage that, having better scalability for the assets. Second, Lightning Network is giving a better privacy to Bitcoin, and this token model can use that privacy, leverage that privacy. But third, the Lightning Network itself, as Philipp already explained, already has to solve these two very difficult challenges. When you are opening a Lightning Network channel, you can transmit Bitcoin zero fee, zero waiting time. That's great. Like, what can you ask more? But you have to be online to receive, unless we do some particular trick. That's the solution. So you have to be online to receive Lightning payments, which compared to Bitcoin is a very bad user experience. Also, you have to store the partial channel update transaction that are not on the blockchain. So in Bitcoin, you have your seed, you have everything. In Lightning, you need your seed and the last you need the set of all the previous partial transactions. With L2, you only need the last one, but still, you need to save some data. So that's wonderful, because we realized that the work on Lightning Network can be leveraged and even helped somehow to try our client-side validation model. So that's what we are doing here. So basically, what is RGB? RGB is a client-side style based design. I will not discuss proof Marshall tonight because I'm going too slow. There is a native integration with Lightning Network, so we can color with the asset, the channel, so I can put my CryptoKitty inside the Lightning channel and I can give it back and forth to you, zero fee instantaneously with very good privacy. We can do colored routing, which means that if I have a colored channel with you, I will explain that in a slide in 1 minute. Also, we are leveraging Lightning Network's need for an independent backup. We are leveraging Lightning Network's need for an off-band transmission protocol peer-to-peer. We are leveraging Lightning Network's need for more payees information in the invoice. So we are reusing all the information of Lightning Network to make the client-side validation model work, which is cool. Yeah, that's basically what what RGB proposal is. So I'm running very late, I think. So I will try to, or not, yeah, I guess so. No, 5 minutes, yeah. So I give you some. Also, your faces are a little bit showing the signs of time passing. So, very quick, some slides to represent some mechanism. This is a normal asset issuance. I'm the issuer. I public the contract for the token or the asset on a server, and I put the commitment of this contract, only the commitment, without using any space, using a technology called pay-to-contract, on the Bitcoin blockchain. So I'm not wasting any space at all. I'm putting the proof on the blockchain. Of course, this kind of contract can represent a collectible, like the CryptoKitty, or it can represent maybe a signing commitment to do something like a token sale. So if you pay to this address, the people that pay to this address has the proof to move this token forward. So you can do your scammy ICO, you can buy your Lamborghini, or you can even do what is now called a fork, which we will better call an airdrop. So if you own two Bitcoins at this date, now you own automatically, you own 2 Bitcoins and 2 of my tokens. You can do that with the RGB pretty easily. We already have the contract to do that. Then you have the transfer. In the transfer, Alice wants to give a CryptoKitties to Bob. So Bob sends an invoice to Alice. The invoice contains the information to reach him. Alice gives the proof, the complete proof, to Bob directly, and she only puts the commitment of the proof, not the proof itself, on the Bitcoin blockchain, client-side validation model. And the token is transferred, a very private, kind of scalable. But the best is yet to come here with Lightning Network. So I want to open a channel with Philipp where we can exchange our token. So he's going to send me, Bob is going to send Alice a connection request. Then we negotiate the channel opening. And inside the negotiation, we put the proofs of the asset. And then we can just create a funding transaction, and we can update the channel back and forth a million times with basically 0 fees and 0 confirmation time, which is pretty scalable and pretty private way to send tokens. The very cool thing is that we can also route our token. So Alice has a channel. Alice wants to send a CryptoKitty to, no, not a CryptoKitty, let's say an ICO token to Erin. Alice has a colored channel with Bob. Bob doesn't have a colored channel with Carol. Carol doesn't have a colored channel with Dan, but Dan does have a colored channel with Erin. So we can pass through Bitcoin liquidity. So I have the colored channel. My final recipient has a colored channel. All the people in between don't even know what RGB is. They are just normal Lightning Network nodes, but they are working for us, since we are using a modified Lightning Network routing algorithm. They are working for us to transmit our token with the HTLC-based contract. Of course, this stuff cannot work with the CryptoKitty, strictly speaking, because in this case, if I want to route a token, the token has to be fungible. I mean, the single CryptoKitty is either on the Alice channel with Bob or on the dance channel with Erin. I can transmit any kind of fungible token like Tether, like Biscuit DAO token, whatever, my company shares, but not a single collectible, because a single collectible cannot be in my channel and in the final channel. If I want to move a single collectible, I have to close this channel and open another channel, and then we can move it. But I have to go on chain for that, unfortunately, by definition anyway. The very nice thing is that if you are following me so far, which is very unlikely, you will already understand. You will probably you probably understand already that you can use this mechanism to do a decentralized exchange natively from Lightning Network. So you have Bitcoin, you want to buy some Tether on RGB, you just send a Lightning transaction exchanging with yourself, and you will leverage all the channels in existence to automatically exchange with the market rate signaled by the node, the RGB node, in order to give you the best execution of the exchange. So this stuff is already built-in decentralized exchange. Now I sound like an ICO scammer, but this is very, very cool. Don't use it, don't give me your money, but this is very cool. I will not go into any details about Proof Marshall because I don't understand it. Only Peter Todd does, so go find him and ask him. I don't really know how it works. So finally, what do we need? We need especially people criticizing the idea. So with our main developer, Alekos Filini, we created a working demo of this protocol 1 year ago in Python to prove the concept, and it does work, kind of. But now we realized that we made a lot of assumption, a lot of arbitrary assumption that maybe are not the best. So we basically throw all the software away, and we're going to write everything from scratch again in Rust. But before we start writing everything again, and when I say we, I mean him, I first want to have people interested in this stuff engaged and criticizing the idea and providing feedbacks on the specification. So until I would say until let's say the end of September, we will continue discussing the specification. Alekos is already writing Rust code, but not set in stone. We will discuss specification, and then the end of September we'll start writing everything again from scratch. Specification are right now on GitHub, rgb/org. Some parts of the specification are pretty much complete, some other are practically empty, so we still have a lot of work to do, even just to formalize. So what is there? There is an introduction where I verbosely explain what I explained to you tonight, so don't read it again. So there is the RGB core kernel repository, which is the proof system which contains all the relevant stuff. So if you want to receive a payment of a token when you are offline, you need an online server to receive this payment for you. So you need a good system to receive transaction that stays always online. Something like your Lightning node that stays always online and receives RGB payments. At the beginning, we called this stuff Rainbow, but then Rainbow was not like manly enough. It was, I mean, we are a very welcoming, open-minded group, but we're mostly guys. So Rainbow was a little bit like, I don't know, a little bit Ethereum. So we decided to call it Bifrost, which is more manly, like, you know, Bifrost is a rainbow in the north of Meetup, yeah. So there is Kaleidoscope, which is the wallet implementation, nothing graphical interface, only command line in order to intermediate all the functions. There's the Proof Marshall repository, which is Peter's stuff. And there are some futuristic ideas that I'm not going to discuss. Well, I just give a very quick mention. Confidential assets, which is a very, very cool technology implemented on Liquid sidechain, can be implemented on RGB as well. So we are discussing with Blockstream people in order to try to implement confidential assets in the future, not now, on top of RGB, if the project succeeds, and maybe to have some kind of interaction. Also, we managed to involve some counterparty guys that are willing to make us as much interoperable with counterparty as possible, because counterparty is not a scam project. It's somehow, it's somehow a dignified project. And then we will discuss some other zero-knowledge magic, like we can do ZK snarks in theory on top of RGB, because the kind of proof that you put in the client-side validation doesn't matter. So we can do a lot of stuff, and we can try some trusted computing way to enforce complex smart contract. I'm not going to discuss this, but it's a cool idea. So questions, feedback, or insults can be sent to my email address, which I basically never look at because I have a backlog of 6 months. But it's better if you write me on Twitter or on Telegram with @Giacomo Zucco. There is also a Telegram group, RGB Telegram, where you can ask questions. Don't ask how much the RGB token is going to be worth. We are not issuing any, there is no ICO, no token. We don't want your money. So just ask technical or economical question, please. No Lambo for you this time. And this is again the address of the repository. And yeah, I think this is all. I will gladly take any kind of question later during the Q&A time. And just an inside joke for people involved in the space, and I'm finished. Thank you. Stay up? Or?
Yeah,
Okay. So you have time to participate.
Yes, thank you very much, Giacomo and Philipp. It was really very interesting.
Now,
Yeah. Yeah, you frightened us a bit regarding the ICO things and the other blockchains, but anyway, we will not sleep too well. But anyway, what interests me, could you please explain a little bit how privacy is going to improve by Lightning, and whether also Lightning transactions can be traced by forensic tools in the future or whatever?
so basically, as Philippe explained, a Lightning transaction is between Alice and Bob, the owners of the channel, and that's all. But in a channel, everybody knows everything of the counterparty. So if Philip is paying me, I know that he is paying me. But when Philip is using me to route the transaction to a final party, I don't know where the transaction is originating, and I don't know where the transaction is going. So I'm Alice. Try to imagine it. I'm Alice. And I want to pay Bob, which is down there. I don't have direct connection with Bob. I need to pass through 7 hoops. So I will understand the path, so you, and you. Then I will encrypt the final transaction inside the previous transaction, onion style, and I will give him the first transaction, and he doesn't know if I generated, he doesn't know the content of the, he does know the amount, but he doesn't know if I'm paying and if I'm paying Bob. He just knows that I asked him to pass this to him. Then he gets the second hope. He does just know that he asked him to pass the transaction to him, but he doesn't know where it finishes. And there is no global state that somebody could watch from the outside. So there is not a blockchain. You don't go to a blockchain explorer. So that graph of Lightning nodes that Philippe showed you, this just tells you which nodes are signaling themselves as open to routing your transaction. That's all. There are many Lightning nodes that are not on that graph, and you don't know what's happening inside the channels of that graph. So people routing the transaction doesn't know what's happening. So assuming that you have several hopes, the privacy of Lightning Network is pretty good. And also the fungibility improvement for Bitcoin of the Lightning Network. And I continue to insist that fungibility is a key aspect of every kind of money. Swiss francs, they have fungibility because when you receive a payment from a bank, the bank had the legal privilege to clear that money for you if they did KYC. You don't, when you receive a Swiss franc, you don't have to search for the history, the criminal history of all the previous steps in the transaction. You just trust the last one, and if you do KYC, you just have to check the last one. Then there is a bank in the middle, and they clear it for you. And then it's a problem of the regulator and or the law enforcer to go to do police job to try to search for the previous cases. But it's their job to try. It's not your duty to check before. So you can accept Swiss francs. With Bitcoin, if you don't have fungibility, it cannot work as a payment system, because if every time you pay me well, to Bitcoin is a little bit too much. But every time you pay me 200 Satoshis, before accepting, I have to make sure that these specific Satoshi do not come from Julian Assange, because United States government don't really love Julian Assange, and so maybe I will be in trouble. That cannot work. My payment system cannot work without fungibility. So fungibility is important. So assuming that there are multiple steps, multiple hopes, Lightning Network privacy is good. Of course, if everybody just connect with one hope for conveniency, and everybody just ask Facebook node to rely every single hope, Facebook will know exactly everything. But the nice thing is that worst case scenario, Facebook does know everything that everybody knows now looking at the blockchain. So worst case scenario, the privacy, if everybody uses just one relying node, the privacy of Bitcoin is the same of now, basically. The only difference is that now everybody can spy on everybody. In that case, only Zuckerberg can spy on us, which is that's just normal stuff, the usual situation. So worst case scenario is still Bitcoin. Best case scenario, just a couple of hopes which cost nothing. You have a pretty good privacy. So privacy of Lightning Network is a great improvement. If you have to ask.
Nothing to add.
Any more questions?
Thank you for a very interesting speech. I have a follow-up question. So if you do that on the Lightning Network and it's with high privacy, and in the end you will settle down to the Bitcoin network, right?
Not necessarily.
Not
in the
necessarily.
end, somebody may settle down to the Bitcoin network, but that's the settlement only happens when you have to move this channel to another channel, or where you have to solve a conflict. But in a normal situation, you could keep a Lightning channel open forever.
Okay, I see.
And when you settle down only with the final state. So let's assume that I open a channel with him and a channel with him. Then I have 200 transactions going this way, and 200 transactions going this way, then I close, and people say that I have the same amount that I open with. They don't see any difference. I open with half a Bitcoin, I close with half a Bitcoin. But in the meantime, I was the routing partner of millions of transactions, but I just kept my channel balanced. So at the end, you don't put all the information back on the blockchain, otherwise it's pointless. You just put, if you need it, the last commitment.
Okay, thanks.
There's something that I forgot when I was talking about the channel stats. When you don't settle the last state of a channel, you get a like penalty. So all of the funds in that channel will be going to the not cheating party. So that's kind of a motivation not to cheat. You will get a penalty if you try to cheat that.
Yeah, just a follow-up comment. Lightning is not free. There's not such a thing as a free lunch. Lightning is zero fee, kind of good privacy, zero confirmation time, but security of Lightning Network is degraded in respect to the security of on-chain Bitcoin for at least 3 reasons. First reason, you have to be online with your key, hot wallet, to receive. You have to be online with your key to route, and also the security model is not validation-based, but as Philipp said, is punishment-based, which is still good, but a little bit different. Like you could suffer a DDoS attack in order to prevent you from sending the punishment transaction. So it's very cool, right, actually, because when you want to send a lot of money, you don't mind paying high fees, because you are sending 2 million to Venezuela, from Venezuela probably, to Switzerland. You're selling 2 million Swiss francs, and you don't care if you have to pay even $50 and wait for 1 hour. It's pretty good compared to a wire transfer. But if you have to send a micropayment several times a second, you do need speed and cheap transaction. In that case, in the first case, you really care about security. In the second case, you care less about security. So I would say that you have to imagine that in the future, the blockchain is like your saving account, like your settlement layer. When you move big amounts in a very secure way without waiting few hours, spending few dollars. While the Lightning Network is the small amount transaction, you probably don't want to set up a Lightning node with 200K Swiss francs routing. Actually, you can't. In the current implementation, LND, C Lightning, Eclair, the Rust implementation, the developer agreed to put a limitation. Of course, if you're good enough, you can remove it, but if you're not good enough, you can't. That's because they want to avoid people losing money. I don't know if you see the difference between Lightning Network development and the DAO developers. A little bit different cultures.
Can a Lightning channel fail, and what happens if that information gets lost? I mean, I understood that it is stored externally, and what happens if...
So there is a current model which is called the original Pundraya model, in which I have to keep my seed, of course, to sign, and every single past state, because if I lose the final state, I cannot close the channel. If I lose some state in between, if you try to close the channel trying to steal some of my money, I need these past states in order to punish you. So I have to keep everything. And that's also quite bad, because if you get in possession of one of my... So if I put my partial transaction on Google Drive or on my computer and you can find it, you can broadcast my past transaction trying to you have to sign it, but still. So they're called cryptographical toxic waste, because they're not neutral. People that can find those partial transactions can damage me. But there is a new model of Lightning called L2, which is like a joke about layer 2, L2, written E-L-T-O-O. And this new model is not punishment-based, is validation-based, but it needs a soft fork on Bitcoin to add a new opcode, which is called SIGASH no input. So I will not expect that in production for a couple of years still. But SIGASH no input is a great idea. It makes everything simpler, but probably we have to wait a little bit, because Bitcoin it's like the internet, slowly, safely, steadily, independent, difficult to manipulate. So we don't rush, we don't move fast, and we don't break things.
Well, I work for a bank, and I also run my private Bitcoin and Lightning node. And I want to hear your opinion. There are countries which try to ban Bitcoin. What does Lightning mean to those countries? If a country is trying to ban Bitcoin altogether, so not just some specific users of Bitcoin, the increased privacy is not really relevant. They will try to ban you in general. Let's say that the need to stay online in that case is not an improvement in yours. If you're trying to run your node illegally in a country, not you, but your cousin, of course, you will never do that. But your cousin is trying to run illegally a node in a country where it's banned. If you're just running a Bitcoin node, there is some complexity. But if you try to run a Lightning node on top, you have even more complexity to stay on Tor. I mean, in theory, it's compatible with Tor, with onion routing externally. So you can do it. But I will argue that it's a little bit even more difficult to do both, because right now you have to do handshaking to create the channel. It's still very early stage, connection fail. So if you also have to stay super private, it's not easy. So, but ultimately, it doesn't change anything. Bitcoin was created to be impossible to ban. That's like the internet was created to be impossible to nuke down in a nuclear war. Bitcoin is created in order to be impossible to shut down in a legal war. That was its purpose. And so far, it's working pretty well. Litecoin is just an extension. We could say that like TCP/IP, right? IP for the internet is every node is pinging every other node, trying to find routes. While TCP is the direct connection. We could say that LN, BC, Lightning Network and blockchain are the two, or actually, Lightning Network and blockchain are the two layers of Bitcoin. Bitcoin blockchain layer is slow, safe, expensive. Bitcoin Lightning Network layer is fast, cheap, a little less secure. From the censorship point of view, I hope that in the end you will be able to install a single program with both a Bitcoin core node and a Lightning node flawlessly in a few years.
More questions?
Earlier you said the proof of stake wouldn't work. Could you explain why?
The first idea of proof of stake was, as I said, a brilliant guy, Wei Dai, the inventor of B-Money, was trying to do something like Bitcoin in 1998. And his design, his second proposal was based on proof of stake. So the idea is, we can just validate the signature on the transaction independently. We don't need any blockchain to do that, any proof of work. I give you a transfer, you can validate my signature and the signature before mine and the one before and the one before. The problem that you have is that you want to be sure that the chronology is universal for everybody. Otherwise, I can double spend you. I give you a transaction, I give the same transaction but different to him, and now the network will converge on his version or your version, but you don't know which one. So your payment is never final. So you stay there. So if you have a set of validators, let's say that you have a federation of 36 banks, like in R3sev, Corda, you don't need any blockchain. You just need voting. The transaction that collects the most votes, you can use PBFT, Tendermint, Byzantine protocols, but you don't really need any of that. You just need majority. And the protocol with most votes is the final. The transaction with most votes is the final. The problem of Wei Dai is that he wanted to do something without involving a federation of known fixed counterparty. He wanted the parties to be able to join or to leave the network. So how can we trust them? Because if we make this kind of network vote, I can pay him, then I can pay myself, then I fire up 2 million of fake nodes voting for me on Amazon AWS, like the Bitcoin Cash nodes, basically, or on AWS. I can easily fake nodes. So in order to prevent me from faking nodes, Wei Dai said I should put some stake of digital currency on stake, and if I try to cheat, people will just delete my stake. So I know that I cannot do Sybil attack because the money is scarce. The problem is that there is a recursive logical problem there. I'm trying to enforce scarcity of an asset using as a stake scarcity of an asset. With this logical loop creates a vector attack which is called a long-range vector attack, in which basically 3 years later, I buy or I steal some keys, and then I go 3 years in the past, and I use that stake to vote for an alternative history, which has now more nodes on top than mine. So the idea is proof of work is taking scarcity from physics, thermodynamics, and putting this scarcity on a digital world. Proof of stake is taking the scarcity from the digital world, trying to put the scarcity onto the digital world. What is scarce in proof of stake? Your stake. But why is your stake scarce? Because the proof of stake says so. There is a logical recursion there that people pointed out way down in 1998. So Satoshi Nakamoto stopped, and other people like Nick Szabo, they stopped working on proof of stake because of this logical fallacy, and they started working to proof of work, which is, I mean, it does destroy the environment, whatever. Then, as many times it occurs, people which is better at marketing that technology takes a very old idea that didn't work 5 years ago, and I present it like new, and I create a lot of marketing around it, and I make money and Lambos, and that's happening to proof of stake as well.
Yes, you also said that tag is not working, or did you?
Yeah, I did. I think that's, of course, these are all my opinions, which are right. But no, I don't know. I may be wrong sometimes. The DAG is not as messed up as proof of stake. Proof of stake has a fundamental logical problem. Proof of stake can be used on top of proof of work. So if you have or on top of other stuff. So if you already provided a base layer of scarcity with some real stake with proof of work or something, then proof of stake can be used on top to do something. So that could be a good use case. Proof of stake on top of proof of work. DAG and tangles and DAG coins and briding. So if you want to read the best research about DAGs, is actually made by people working on the briding idea, because of course you can have your tangle diverging, and then you need somebody converging it with a briding. So if you search like scaling Bitcoin, briding, you get two very good presentations. So it's a nice idea. It's an old idea. People started to discuss that on Bitcoin in 2013, but then they realized that the graph diverges, and the economical incentives to make it converge again are, we don't know if they are possible, and nobody ever managed to make that work. That coin experiment didn't work. IOTA experiment does not work even with a centralized party which is called the coordinator, and yet the network has diverged, and yet they have a centralized party in deciding, so you can understand how difficult it is to make that stuff work. If we can make it work, the advantages are not the ones you are told about. It's not true that with a tangle there is no proof of work, there are no miners. Specialization kicks in anyway, so even if you have to perform your proof of work on your own to send a transaction, some third party will specialize in selling you that proof of work, because specialization and economies of scale are a fact. So tangle, DAG, like not blockchain but block graph, transaction graphs, they are not so different in the end from blockchain. They have some advantages if they work, and they don't, because they make attacks like selfish mining impossible, and they have an emergent consensus over scarce resources like let's say block size or block rate, block frequency. This stuff can emerge more naturally by a graph, and if you have a split, which is bad, you may have a briding, while in blockchain, if you have a split, that's basically forever. So you have some marginal advantages. It's an interesting field. Unfortunately, there is a lot of noise on the field right now because it was used as a marketing idea to buy Lambos, and so now nobody knows which is the noise and which is the signal anymore.
Yeah. Can you give an outlook on the use cases by banks, or adoption by banks, or
Of Bitcoin?
Of Bitcoin?
Long answer, in theory, but in practical, just 30 seconds. Not everybody, so my personal value proposition for banks is, what Philipp said about being your own bank is true. That's the point of Bitcoin. But not everybody wants to become a Bitcoin user leveraging that value proposition. Somebody wants just to become a Bitcoin investor, and we love those guys. I mean, we have nothing against people becoming Bitcoin investor. They make us richer, so it's okay. So the real Bitcoin user needs to learn private key security, which is hard, private key backups, run your own full node, otherwise you get you are trusting miners and you can be scammed by miners. So it's very, very hard. Maybe an investor doesn't want to become a Bitcoin hacker. He just wants to invest in Bitcoin commodity, just like investing in oil or Apple shares or whatever. So he wants just to take his phone and say to his bank, please buy me to Tesla, unless he delisted, but anyway, buy me something and then buy me some Bitcoin. I think this is a valuable scenario. Many investors will not become Bitcoiners, just Bitcoin investors. And I think that banks, some Bitcoin startups are already trying to provide this kind of support, which is threefold. First is the technical support. You don't have to learn how to store your key or how to run your node. I take care of it, just trust me. Second, it's a market support. You don't have to understand the price, the market. I will do best execution for you, just trust me. Third, you don't have to learn regulation. How do you do accounting, taxes? Don't learn that stuff. Just buy my certificate or ATF or whatever, and I will take care of that for you. I think that this is actually a good use cases, and some Bitcoin startups are trying to do that. But I think that the entities which are most in the best position to do that are existing banks themselves, because they are already regulated, insured, they already have security policies, if a bank can store your gold, a bank can store your Bitcoin. So 90% of my job is to teach Swiss banks how to keep Bitcoin of their retail investor without losing them. It's a difficult job because the challenges are unprecedented. Like a bank right now can imagine a physical gold deposit in which somebody can enter with a bulldozer, take everybody and run away with good plausible deniability, but at least the price of gold is volatile, but it's slow. There is not a lot. It's not that if I put some gold in a trunk and I transport this gold, the value of the content of the truck changes during the first minute. The slippage is containable. So it's not very volatile, but it's very, very physically risky. While on the other hand, I have very, very volatile exotic derivatives. They are super volatile from a financial point of view, so the market risk is huge. They can crash, they can go to zero, they can evaporate, but I don't have physical risk. You cannot come in with a bulldozer and steal a lot of derivatives and run away. I mean, in theory, maybe you can with the primary certificate, but it's very, very difficult. So the challenges are different. Bitcoin has both the challenges. I can be a rogue employee of your bank. I can steal your Bitcoin with good plausible deniability, and the price of your Bitcoin is changing every minute, and you can have like splits and forks and airdrops. And if you put your gold in a safe, there is not a scammer that can create gold cash in order to duplicate your gold with the scam gold, and you open your vault and you find it. So you don't have to manage this situation. With Bitcoin you do, and you have to understand how to manage it. So there are a lot of challenges. I don't think that banks will get it right very, very soon. I think the Swiss or Liechtenstein banks are in a very good position because Eurozone banks will be forbidden by the regulator to do anything useful for the customers in this space for many years, in my opinion. So they will be like the last one adopting this new use case. And I think that banks with a more looking forward regulator, more open to financial privacy and to innovation and to sound money, which I think Switzerland in part is, and Liechtenstein Principality as well, could maybe take the pole position for this stuff.
I think two more questions then.
You said you teach the banks in 90% of your business. So what is the problem? If you teach the banks, why do they not enter the crypto business in Switzerland? What's the problem? Why can't you convince them to enter into that business?
Oh, well, I can. They are, I have clients which are providing Bitcoin investment for retail customers. The problem is that they are still afraid of reputational risk. And so the main problem I'm facing in my job is the pendulum effect of reputational risk. 2 years ago, I was explaining Bitcoin to especially Italian Switzerland banks and why they should provide Bitcoin investment for their clients who are asking for that. And the response was healthy skepticism. Like, I don't know, I was making a point with some kind of portfolio management evaluation, technical, like if you put Bitcoin in your asset basket, you can decrease the overall risk of your basket because it's a decorrelated asset class. So it doesn't matter if it goes up or down. It goes up and down in a different way than shares and physical commodities. So you can use that to reduce the risk. So that's a great value proposition. But they were like, yeah, I don't know, but you know, the money laundering and Bitcoin and I don't know, it's scary. And they were very conservative. Then the pendulum switched at the beginning of the last year, and they started to tell me like, yeah, I want Bitcoin, but I also want Litecoin and the ICO of my cousin and that stuff. And basically they just canceled any risk awareness, and now they wanted everything, which is not a good idea, because first, altcoins are not decorrelated from Bitcoin. Altcoins are correlated to Bitcoin, so they are like just Bitcoin derivatives. And when they will be decorrelated will be when the bubble of the altcoins will crash, and they will decorrelate in a very bad way, like .com companies. So altcoins are not a good idea. And even if you financially you think that it's a good idea, I mean, okay, I'm here, I'm your provider, so I will teach you. But you don't have to think that with the same effort that you use to manage one Bitcoin node, you can manage one Bitcoin and Bcash and Litecoin node, because that's not true. You will have a lot of complexity, which will basically, I mean, right now to do some multi-sig scheme, we use a modified version of Electrum. They asked us to do the same with Litecoin, but the Electrum version for Litecoin is not maintained, is not secure, is not reviewed. The version Litecoin, the version of Electrum for Bcash, they didn't even check the name of the program, like it's Electrum, but then it's Electron. It's a mess, and it's full of bugs. And so you cannot rely on that. And we don't want to take part in anything that will reveal as a disaster. So I have a lot of complexity. I mean, it's very difficult to communicate that there is some innovation which is actually interesting, but not everything which is new is interesting. So there is this pendulum effect, which is hard. Mostly they are doing retail investor and funds privately. Funds are a problem because right now crypto funds, in order to show some value proposition to the market, they have to pretend to differentiate. They have to pretend to create a hedged allocation. But there is not such a thing as a hedged crypto allocation. There is Bitcoin, and there are these crazy derivatives. So crypto funds are problematic, in my opinion. I would prefer my clients to serve retail investors. I want Bitcoin, buy and hold for 10 years. So yeah, so the ecosystem is messy. I didn't see personally any, in Switzerland, any close approach from the regulator, unlike in Italy, don't even consider it. But in Switzerland, both FINMA and the central bank, for my experience, has been open to that, even too much in a way, I mean, for some things. So I think it will take off. If it doesn't, it will be because maybe the Wall Street ETF comes first, so the custodianship will just be in Wall Street, and everybody else in the world will just trade ETFs on top of that, which would be a pity, because I think that, I mean, this part of the world can be right now a better home for Bitcoin than Wall Street itself. So it will be a pity. If people just wait for the SEC to approve, maybe it will be too late, and banks will just sell to the customers the ETF.
Final question, maybe Bitcoin as a means of payment.
So the main function of Bitcoin right now is for permissionless saving, not for permissionless payment for people like us. I mean, for me, I mean, you know Gresham laws, right? Under legal tender, first you pay with the bad money, and you save the good money. So if you are in Venezuela right now, first you pay with the Bolivar, and then you pay with your illegal dollars stake, or your cousin's illegal dollar stake. For the same reason, I don't pay with Bitcoin if I can pay with Swiss francs or dollars or euro. I do pay with fiat money first, and then I save Bitcoin. So, but I'm privileged. I'm living in Europe. I'm not suffering hyperinflation yet. I'm not suffering a lot of robberies, especially since I moved out of Italy. Swiss government is not going to rob me very often. So I don't use a lot of recreational substances on the dark web, so I don't spend Bitcoin. But some people need Bitcoin also to spend, like if you are now in a country where you are completely unbanked. So there will be niches that will use Bitcoin as a mean of payment, especially with Lightning. I'm talking especially black market and gray market. Gray market is something that is like gray market is something bad, but gray market is actually the majority of people on this planet. They don't have a strictly KYC identity and permission to do financial things. So they are excluded from the main KYC-based financial system. So a guy that wants to do an e-commerce in Somalia, he cannot get PayPal. Maybe M-Pesa. So there are other solutions than Bitcoin to do that. But I think that Bitcoin will be a very good solution for the market of permissionless commerce, of all the commerce that is not illegal, is not terrorism or organs. It's just people that wants to trade without bothering to ask for permission, which is slow, a lot of friction. If you think about that, we say that Bitcoin is fast. Bitcoin, technologically speaking, is not fast. It's without Lightning. Bitcoin blockchain is super slow. The reason we think it's fast is because a wire transfer is incredibly slow, but it's not slow because of technology. SWIFT is pretty much fast as a technology. The problem is the regulatory part that is created to create friction, because the regulators want to control, and control creates friction and creates exclusion. So I think that Bitcoin will be used for e-commerce, especially for people that cannot, it could be people without an identity, maybe in the third world or in developing countries. It could be people that maybe are doing a business that is too much international to comply with every regulation. If I had to set up a business which implies paying 100 people in 100 different jurisdictions, I cannot do that with banking system because it's just too much overhead. I can do that with Bitcoin because I just don't care. If I take my precautions, of course, or my cousin. And then you have like the business which are just too new to be regulated. Like I want to create a machine-to-machine payment in which my fridge pays for my drone to go to the mall. This is a very fun science fiction case. But if I do that, there is, I cannot open a PayPal account for my fridge, legally speaking. Technologically speaking, PayPal can manage micropayments without any problem. The problem is regulatory, not technological. A centralized system is forbidden, or it's inconvenient for them to try to understand which regulation applies when you try to make your fridge open a PayPal account, which is a problem. Self-driving cars, paying for gas. Who is going to open the account? Who is the KYC? Where the producer? Whatever. With Bitcoin, you just do, and then you say you're sorry after.
Yeah, thank you very much. I think this box interests me. Where did you buy this box, and what was it usually bought for? And
it's just a normal IKEA box.
Okay. And what was it meant for instead of being a like a server or something?
It was meant exactly for that.
Oh, really?
Yeah.
Okay.
I just bought it for that, yeah.
Good. Yeah, I think this will be in a museum in some years as the first publicly shown Lightning node of Liechtenstein. Okay, thank you very much, Philipp and Giacomo. We have